Hey guys, it's Jack. Today we're going to be looking at a very specific fund on Vanguard, which is sort of unnoticed. To ultimately decide whether it's a good fund for you to make money through either passive income through dividends or capital appreciation. This is just my opinion. I'm just a nerd on the internet and not financial advice. The fund we're going to be talking about today is the ftse UK Equity Income Fund. Straight off the bat, the fund gives a really significant amount of dividends. That is 4.5%. This is about above the average of the FTSE, which is known for its dividends in the first place. Unlike the S&P 500 and all of the world ETFs, this fund only comprises of around 74 stocks. The fund follows a specific rule, and that is that the fund only invests in companies, tracks the companies in the LSE, the London Stock Exchange, that are expected to pay a higher amount of dividends than the average amount. We're going to be looking at these stocks in a second to see some of the highlights on what's good and what's downright trash. But before we do that, let's take a look at some of the information around the dividends and how it's paid out. You can get this fund in two forms, the accumulation or the income version. The difference between these two is that the accumulation fund will invest the dividends automatically back in the fund, giving you more shares in the process, whereas the income variant will give you the dividend payment as cash for you to either invest it, withdraw it, or splunk it on whatever. As well as this, the entry price for the fund varies a lot. The income fund is around £150 a share, whereas the accumulation fund is around £260. I'll show you how to lower these at the end of this video. Unlike a lot of the other funds, this fund gives you a dividend payment semi-annually, semi-annually, however you want to say it. Basically not on a quarterly basis. This presents a first disadvantage of the fund. The drawback is that the lower the frequency in payments, the less benefits you're going to receive from constant compounding, which could ultimately lead to lower returns. It's why something like the realty income stock is so popular. It gives a dividend payment every single month. You get a benefit of that constant compounding effect. This brings me on to the second disadvantage of the fund's fundamentals. We'll get to the advantage in a second, hold your horses. But the disadvantage is that you can't rely on this fund for income. Income is in the fund's name. It's sort of implied that the specialism of the fund is giving you an income. But how are you meant to pay your bills when you're waiting 6 months for an income? Obviously, if you have other good income streams, a nice cash flow or savings pot, it's not going to really matter. But if I'm investing for income, I want the payouts to be sooner. Now, before we look into the returns of the fund, let's take a look at some of the holdings. It's not an equally rated fund, and due to the weighings percentages, the top 10 holdings make up around 48% of the fund. It's worth taking a deeper dive into some of these. The highest weighting is Glencore PLC. This is a commodity trading and mining company which specializes in oil and gas. Although it's gone up around 70% in the last 5 years, I don't know if I want a commodity play to be my largest holding in an income fund. Commodities are quite volatile. A change in US relations, some OPEC deal crashing, or some flat out war breaking out could affect prices dramatically. And if I'm investing for income, I want to lower my risk and my volatility as much as possible. Although the company has gained 70% across the last 5 years, it's still down 39% since its first IPO date. Perspective is everything. Now, the second biggest holding in this fund is GSK. Now, I'm a big fan of GSK for a number of reasons. One of them is the fact that their dividend is high, around 5.5%, but mostly because of the fact they're a member of the UK Dividend Aristocrats Index. To be such part of this index, to be such part of this group, you have to give out a stable or increasing amount of dividends for the last 10 consecutive years. Now, when we're investing for income, we want to look for safety in these dividends, as well as the fact that they're part of such aristocrats index. Their business itself has an implied level of safety, economic safety. Nothing is completely safe or is free, but judging by the fact they're a pharmaceutical play, they're less likely to be affected by economic downturns. People aren't price sensitive to medicine. The only thing I would say is that their payout ratio is quite high. They're paying out 76% of their net income to shareholders, which means they have less money to reinvest in their business to grow further and less money to pay down debts. Now we've discussed the top 2 holdings, let's take a look at the companies of concern. One of them being British American Tobacco PLC, 4th largest holding in the portfolio, which has lost 42% of its value over the last 5 years. If you have been an investor in BATs, you would have lost 42 pence of every pound. Imagine how that feels. A lot of people love this stock and tell me it's a value play, this, that, and the other. But look at the macro fundamentals. They don't lie. You're investing in a company within an industry that is dying. The regulatory environment is making it much difficult for these tobacco companies to market their products, to sell their products, and just deterring people away from smoking, which is a good thing for society. Despite the numbers, despite the revenue that it's bringing in today, I personally think the industry is going to shrink in the next 10 years, and there's going to be a whole consolidation that's going to take place within all these tobacco companies. I will explain how you can get around this in a second, but before I do, let's take a look at the returns of the fund overall. A £10,000 lump sum investment 10 years ago would be worth around £10,600 today, a 65% increase. Now that might sound like a lot, especially because it's not including dividends. But let's compare this to other funds. You can look at the S&P 500, which has delivered around 300% in the last 10 years. Your 10K would have turned into 40K. Now, it's a big difference, and although it's not a comparison to be made because one is for dividend and the other fund is for investing in American stocks, but the fact still lies. This is a bull market and this fund isn't moving. The UK Equity Income Fund also has a relatively high risk rating. Just on a fundamental basis, you're essentially risking more money to get lower returns. Obviously, this is based on historical data, but look at the underlying sectors the fund holds. You've got 23% exposure in financial stocks, which is understandable as banking and financial services are in the top 3 sectors in the UK. Is the banking sector going to grow at a high pace in the next 10 years? Maybe. But you're not going to get a good slice of that growth with the stocks here. You've got the likes of HSBC, Barclays. These are massive banks in the maturity stage with an increased regulatory environment, lower interest rates, a huge amount of competition from smaller challenger banks like Revolut and Monzo taking away their market share. It's really a challenging industry. You might not see a flat out declining nature of these particular banking stocks, but I wouldn't expect huge amount of growth unless, of course, the fundamentals change. When you invest in this fund, there is a risk of you losing out on growth and returns, especially due to the fact that these banks are not giving out much of a dividends at the moment. A great thing about this fund is that the expense ratio is relatively low at 0.14%. But as you're not going to be having to pay any foreign exchange fees and the relatively small nature of the fund, it's only 74 stocks, you could just theoretically buy these stocks in an investment pie on Trading 212. By doing so, you could eliminate the expense ratio and take out or replace some of the bad stocks like British American Tobacco with REITs or other stocks that could produce more growth. And as you're able to buy these stocks with fractional amounts on Trading 212, you could easily lower your entry price for the fund, meaning it doesn't cost you £260 every time you want to buy a share in the fund. This particular video came from a comment request from BA. Shout out to BA. If you want to make a request, leave it in the comments or let me know what you think, what you thought of this video. You can smash the like button, it will really help me out. Really appreciate it, and I'll see you in the next one. Thank you so much.